So today's topic of discussion will be EBIT-EPS analysis. As you are aware that this is also one of the tool or technique which help us in taking the financing decision. As a finance manager, our objective is to construct an optimum capital structure. And to construct the optimum capital structure, we want to maximize the benefit in the hand of the owners in the form of earning per share. In the previous lecture, we have discussed about the leverage, where we try to understand the relation between the variables. In the operating leverage, we have tried to discuss and understand the relation between sales and EBIT. In financial leverage, relationship between EBIT and EPS. That means financial leverage is helping us in understanding that what will be the impact on the EPS with respect to available EBIT. Another version that we are trying to take up today with the help of the second technique of capital structuring or second technique of financing decision, that will be EBIT-EPS analysis. That means this can be considered as a further discussion over the financial leverage. Here we want to know that what is the optimum capital structure. That means we want to know the mix of debt and equity. That how much debts the company is supposed to invite and how much equity company is supposed to invite. That means what is the proportion of equity and debt in the capital which is going to give maximum benefit to the company, and maximum benefit will always be known with the help of earning per share. Here we have to start the discussion from the EBIT. That if at a level of EBIT, what is the impact on the EPS? But what we can do, that we are supposed to change the financing mix. We are supposed to change the financing mix, and then we can know that what is the impact on EPS. That means we can keep EBIT as constant. We can keep EBIT as constant, and we can have different options of capital mix. For every option, we should try to calculate what is the EPS. The option which is giving the maximum benefit, that can be considered as the optimum capital structure for the company. That means I am trying to say we are supposed to take up two cases here. First case where the EBIT will remain as constant, and we will try to know that what is the impact on the EPS with the different capital structure. That if we try to bring variation in the capital, then what will be the impact on the EPS if the EBIT is constant? Means EBIT constant, impact on EPS with changing pattern of financing. And second case, we can bring variation in the EBIT itself and variation in the financing pattern, and then we try to see that what is the impact on the EPS. That means at first case we are keeping EBIT as constant, and another case we are also bringing change in the EBIT also. That if EBIT is going to change, financing pattern is going to change, what will the impact on EPS? If EBIT is constant, financing pattern is changing, what is the impact on EPS? As you are aware that in financial leverage we are having cost, and cost we can say in terms of interest and dividend to the preference shares. These are the two costs, fixed costs, which are associated with the financing pattern of the company. That means if whatever the EBIT that we are having, earning before interest and taxes, whatever the earning we are having, if that earning is able to cover the fixed cost of the company in terms of interest and preference dividend, then that point can be considered as a financial break-even. I am trying to define that what we mean by financial break-even. Financial break-even means the portion of EBIT which is able to recover the fixed cost of the company in terms of interest and preference dividend. That means EPS is 0. Earning per share will be 0. Only the interest amount to the debt holders and dividend amount to the preference holder, that much amount company is able to pay off from the level of EBIT. So we can say no profit, no loss. As you are aware also that break-even means no profit, no loss. That means the point where their earning is 0. So here also, if the company is going to make the payment to the interest as well as the preference dividend and nothing is left for equity shareholder, that position can be called as financial break-even. That also means if the company is able to have excess EBIT, if the company is able to have excess EBIT over financial break-even, that position can be considered as a good position and company is in position to invite debt investors in the company. Try to understand, as you are also aware that when we invite debts in terms of bond, debentures or loan, the interest amount paid to them will help us in reducing our tax liability, and moreover earning per share is also going to increase. That means we have seen in financial leverage that if the debts are 0, if the debt is 0, then financial leverage is always 1. Financial leverage will always be greater than 1 if we invite the debt in the capital structure. So here also we are trying to say that if our EBIT is excess over the financial break-even, that means interest and preference dividend has been covered, and after that we are having excess amount to the earning per share, then we can invite more debts in our capital structure, because inviting the more debts in the capital structure is going to increase our earning per share, that means the real owners itself. So in this way we are able to get the judgment that how much debts we are supposed to invite in our capital structure, and if the excess amount of EBIT is not there, then it will be advisable to the company that they should bring the capital in the form of equity shares only. If the break-even is there, or else we can say the excess amount of EBIT is not there, then it will be advisable for the company that they should bring the capital from equity shareholder only, all the capital from equity. But if they are having excess amount of EBIT over the financial break-even, then they can invite debts in their capital structure. Just now I also said that we will try to take up the analysis of EBIT and EPS with the help of two cases, where in first case we will try to keep EBIT as constant and we will try to make changes in the financing pattern. In second case, we will try to bring changes in the EBIT as well as financing pattern and then try to see that what will be the impact on the EPS. That means company is going to have number of options for inviting the capital, and we as a manager have to give the decision that which option of the capital will be best to the company, and we will decide that thing on the basis of higher EPS. Right? So we try to take up this with the help of numerical. So we take up the first case where EBIT will remain as constant and different financing pattern. With respect to this, suppose the company has an EBIT of rupees 3 lakhs, and for generating rupees 3 lakhs, company makes an investment of rupees 10 lakhs. That means 10 lakhs invested and 3 lakhs as earning. Means you can say 30% as earning. Investment amount is 10 lakh and earning is 3 lakh. That means 30%. Company can invite the capital. Company can invite the capital. Capital of what? Capital of rupees 10 lakhs. By making the issue of equity shares, by making the issue of 12% preference share, and by making the issue of 10% debentures. That means these three financing sources are available in front of the company. Either the company can make the issue of whole capital from equity shares, whole capital from 12% preference shares, or whole capital from 10% debentures, or company has 4 options. Company has 4 options, and as we are also aware that inviting the capital from only one source will not give the benefit of the skipped source. जिस सोर्स से हम पैसा नहीं ला रहे हैं उस सोर्स का बेनिफिट कंपनी के पास नहीं रहेगा अगर सिर्फ सिंगल सोर्स को कंपनी ने एक्सेप्ट किया. So company is obviously go for mixing of these 3 sources, and company has 4 options. In first option, only equity share, 100 rupees equity share. That means 10 lakh has to be invited by making the issue of equity share. In second plan, company can invite 50% from equity and 50% from 12% preference. Third plan, 50 from equity, 25 from preference and 25 from debts, that is debenture. And the last, 25 from equity, 25 from preference and 50% for debenture. The company comes in the tax bracket of 30%. Here, as a financial manager, we have to give the decision out of these 4, which is the best option for the company. EBIT is going to remain the same. EBIT will be constant, and we will give the judgment on the basis of earning per share. Let's see. So we are having 4 options: A, B, C and D. A, B and C and D. First of all, we can invite equity capital, equity share, and the rate has been given as rupees 100 per share. In first option, it is given as equity can be brought, means we can write the all options: 12% preference shares and 10% as debentures. Right. In first option, only equity. That means 10 lakhs we have to bring from equity. Nothing from preference and nothing from debentures. Second option, 50. That means 5 lakh from equity, 5 lakh from preference and no debts. Third, 5 lakh from equity, 2,50,000 from preference and 2,50,000 from debentures. And fourth, 2,50,000 from equity, 2,50,000 from preference and 5 lakh from debt. That total, as you are aware, it should be 10 lakhs. 10 lakhs, 10 lakhs, 10 lakhs and 10 lakhs. Earning per share, we can say EBIT. EBIT available to us is rupees 3 lakh. That means if the company is going to make the investment of rupees 10 lakh in the market, from the 10 lakh, company will get the earning after making the payment of variable and fixed cost. The earning will remain as 3 lakh. From this, we minus the amount of interest. In first case, we do not have any debts. Interest will be nil. Second case, nil. Third case, we are having interest as debentures as 2,50,000 and 10%. That means 25,000 will be the amount of interest, because here we have 10% debenture. And here we can pay 50,000 as the interest. This will be your profit before tax. 3 lakh. Again 3 lakh. It will be 2,75,000. 2,75,000 and it will be 2,50,000. Tax rate is given as 30% minus tax at the rate of 30%. Tax rate is 30%. So this will be 90,000. 30% of this. This will be 90,000. 2,75,000. 30%. 82,500. 82,500. And in this case, 75,000. 75,000. $2,10,000. 2,10,000. How much this?
1,92,500.
1,72,000.
92,000.
1,92,000. 92,500. 1,92,500. And here we have 1,75,000. This you can say as earning. Or tax we have taken. Profit after tax. Better. Minus 12% dividend. 12% dividend to preference share. In this case, we do not have preference shares. Here we have 5 lakh as preference share. 12% of 5 lakh? 60? 60,000. Okay, 60,000. Here it will be 30,000. And again we can say we have 30,000. This we can say earning for equity share. Earning left for equity share. 2,10,000. 1,50,000. How much this? 1,62,500. And this will be 1,45,000. Right? Now earning per share. Earning per share. We are having how many shares? Rupees 100 per share. Rupees 100 per share. Somewhere I have written 100 per share. 10 lakhs. How many shares? 10,000. So in this case we can say 2,10,000 upon 10,000. 50,000 upon 5,000. Again we have 5,000, 1,62,500 upon 5,000. And here we have 1,45,000 divided by 2,500. So it will be how much? 21? 21 as earning per share in first case. Second case? 30 in the second case. Third? 30? 32.5. 32.5 and last? 58. 58. That means highest earning per share we are having in option D. So from this we can say that company is supposed to invite rupees 10 lakhs by inviting 2,50,000 from equity, 2,50,000 from preference and 5 lakhs from debts. Now try to have interpretation. I told you that investment is rupees 10 lakhs and EBIT is 3 lakh. That means EBIT is 30% of the investment. 30% of the investment. That means if, that is why you can say that you are having 21 rupees, not 30 rupees. 21 rupees as your earning per share. Because in this case you do not have any interest amount. Interest amount. 30% is a tax. 30% tax. Right? So you have given 30% as the tax. And 30 rupees का 30% हुआ 9 rupees. So 9 rupees has been reduced and 21 left. Try to understand what I am saying. Earning is 30%. That means 30 rupees should be the earning. But we have paid the tax at the rate of 30%. That means 9 rupees has been reduced. It comes to 21. In second case, we do not means again the 30% tax is there, but interest is 0. But we have to give some benefit to preference shareholder. As some benefit to preference shareholder, that is why we can say that it has increased from 21 to 30 because equity shares they have reduced. By inviting the preference share, the equity share number has reduced. So automatically the benefit will pass to the remaining equity share. It increased from 21 to 30. In third case, debts have been involved. Tax benefit will also be there because जितना भी amount हम tax को देंगे उतना ही % हमको वापस भी आ जाएगा. And preference share also, that is a burden for the company. So here you can say that, but by inviting from 30 to 32.5, little benefit because number of equity share remain the same. Only the benefit was left in terms of tax benefit, and that benefit is 2.5. But a high jump is there. High jump is there because equity shares they have reduced from 10,000 to 5,000 now to 1,500. That means maximum benefit will pass to the remaining equity shares. And the benefit will also increase because our interest amount has increased from rupees 25,000 to 50,000. That means more benefit will be passed to the earning per share, less number of equity share, more number of tax benefit, automatically the earning per share is going to rise. So in this way we can say that by increasing the debts in the capital structure, the benefit to the earning per share has been increased because the benefit in saving the tax liability will pass to the owner itself. So in this case we have seen that when we keep the EBIT as constant and change in the financing pattern, then what will be the change in the earning per share? So this will be the best decision, right? So second case regarding EBIT-EPS. The first case that we have taken up where the constant EBIT was there. Now we are trying to make changes in the EBIT. EBIT will change, financing pattern will change, and we have to see that what is the impact on EPS. Suppose we are having three companies, company A, B and C, and all these three companies, they are having the same capital amount of rupees 4 lakh. But company A invites rupees 4 lakh only by making the issue of equity share. Company B invites the capital from equity as well as 6% debts debenture, so 2 lakh. And company C 1 lakh from equity and 3 lakh from 6% debts. The tax bracket, the company comes, all the three company comes in the tax bracket of 30%. And suppose in the present economic situation, the company has all these will have a ROI, return on investment, as 8%. But if the economic condition going to be adverse, it will reduce to 3%. It will become as 5%. And if the economic condition will be good, it will increase by 3%. That will be 11%. That means in the normal economic condition, the ROI is 8%, which may move 3% plus or 3% minus with the bad or good economic condition. Now, we try to see that what happens. We have three situations here. Bad economic condition, we can say as average as well as good. In all the three, we are having the capital as ROI. ROI is given as 5%, 8% and 11%. Right. 5%, 8%, 11%. That means earning per share we can say. What is earning per share? Not earning per share, we can say as EBIT. EBIT. 8% of rupees 4 lakh. 4 lakh investment है. So how much? 32,000. So 32,000 will be the EBIT if the economic conditions are normal. That is 8%. 5% of 4 lakh, 20,000. 20,000 are earning. And here we can say it will have 44%. 44. Right. We are having three companies A, B and C. First of all, we take for company A. EBIT. And you see, company A has no debts. That means financial leverage is 0 in this case. No financial burden. EBIT will be 20,000, 32,000 and 44,000. Minus interest. No interest. Profit before tax. 20,000, 32,000 and 44,000. Minus tax at the rate of 30% is given. 30% of 20,000. It will be 6,000. 30% of 22,000?
96,000.
How much?
96,000.
96,600. 96,600. And in this case, 30,200. 30,000.
1320.
13,200. भाई थोड़ा सा मेंटेन करिए और आई विल वाइंड अप हियर इट। अगली बार से मैं बुक का सवाल लाऊंगा ही नहीं। जो बुक खोल के बैठ जाते हैं ना कि उसमें दिया एक्सप्लेनेशन नहीं दिया है। सो टैक्स 30%, 6,000, 9,600 and 13,200. Profit after tax, it will be 14,000 here and 9,600. So we minus, it will be 22,400. 22,400. And here 30,800. 30,800. Preference shares, we do not have preference shares also. So minus 12% preference share. Nothing. That means everything will be passed. Everything will be passed to the equity shareholder. So earning per share. Earning per share, EPS. 14,000. And how many are shares? 4 lakh, 100 rupees each, 4,000. 4,000. So 14,000 divided by 4,000. 22,400 divided by 4,000. And 30,800 divided by 4,000. How much?
3.5.
3.5. First case 3.5 as earning per share. In second we have
5.6.
5.6.
Yes, sir.
And third will be 7.7. In the same way you have to calculate for for B and C company. See, as we have calculated the earning per share for company A. In the same way, as you are aware that we are going to have debts in B and C both, and you can see that in B and C the debt amount is 2 lakh and increased to rupees 3 lakh. That means financial benefit will be more in the hand of shareholders if the company C is there. In the same pattern, we calculate for B, earning per share is 2.8, 7 and 11.2. For company C, it is 1.4, 9.8 and 18.2. Now, explanation part. As you are aware that here the average was 8%, 5% and 11%. This was the return on investment. In the first case where financing pattern or we can say financial leverage is zero, financial burden is zero. It is zero. 5.6 is the benefit that we are getting in the normal condition, which reduced to 3.5. If the conditions will be adverse. What is the decrease in percentage? 3%. Only 3%.
3.5.
What is the decrease in percentage? 50%. from 5% to 3.5%. So in the interpretation part, that if the economic conditions are moving from normal to good or from normal to bad, what is the increase in the percentage or what is the decrease in the percentage in terms of EPS? EPS will increase to 37.5% and from 5.6 it will rise to 7.5. It means the total EPS will be 137%, an increase of 37.5%. But if the economic condition will go adverse, then also we will have the benefit. But benefits from 5.6 will reduce to 3.5. That means there will be a fall. There will be a fall of 37.5%, and EPS percentage will remain as 62.5%. In second case, where financial pattern has changed and debentures they have been included. When the debentures they have been included, you see the benefit has increased to 60%. Benefit was 37.5%. With the involvement of debts in the capital structure, the benefit has increased to 60%. But as the benefit will also increase, the risk will also increase, and the risk is increased and which has decreased the return in the bad economic condition. That was 60% risk. The benefit will remain as 40% only of the average. And when we increase the financing pattern from 2 lakh to 3 lakh, then again you can see that there is an increase in the earning per share in terms of percentage. We are having 85.5%, 85.7%, which makes to from 9.8 to 18.2. But here, high debentures, high financial pattern, we can say the financial risk has increased. So financial benefits are increased, as well as we can say the financial risk is also increased, and it has reduced. It has reduced to 85.7% here, and the benefit is only 14.3% here itself. So as the financing pattern is increasing, we can say as the financial leverage that we are trying to involve or increase the debts in the capital structure, the benefits are also increasing. But the increase in the benefit, if the economic scenario will go bad, there will be fall in the EPS also. So this was the case with respect to varying EBIT. I hope this is clear. With two cases we have taken, constant EBIT and varying EBIT. So the portion of EBIT and EPS analysis here comes to an end. Right? Thank you all of you.